What's up, Gould Miners? Today we welcome back to the Gould Mine Elijah Brown, a longtime friend of the program. Elijah is the founder of Goldhawk Capital, a real estate investment group that specializes in placing capital into multifamily investments. And in today's episode, we catch up with Elijah and talk about the growth over at Goldhawk Capital that Elijah has experienced since he was last on the show, including the equity brokering business that he has launched as an arm of Goldhawk Capital. Later on in the show, Elijah details the systems and processes that he's used to source and analyze 50 to 100 deals per month on a consistent basis. And then finally, to conclude the episode, Elijah breaks down the criteria you need to look for when analyzing and underwriting a multifamily property to know you're accessing the top 1% of multifamily deals out there. Per usual, Elijah brings an insane amount of value in this podcast. And whether you are a passive investor who is looking to deploy capital into real estate syndications or funds, or you are an investor who is looking to get more involved on the active side of things as a fund manager or an asset manager, there's so many nuggets in this episode, regardless of your involvement and how you're involved in the real estate investment world. So without further ado, everyone, let's welcome back to the program, Elijah Brown.
The Gould Mine Podcast.
Elijah, welcome back to the Gould Mine, man. You are becoming quite the regular on this show. It's nice to have you back.
Thanks so much for having me back. Oh man, the sizzle reels that you made on the last one, those were cool. The like the TikTok and Instagram snippets. I've got one of them on my Instagram. Some of my friends from growing up, they're like, "Who are you now?" Like, you made me sound a lot cooler than I am. So appreciate that.
Oh man, yeah, no. Well, we're trying to up the media game here. I'm constantly experimenting with the content creation right now. So yeah, we'll see. I've got a lot of plans for Q2, and I think I have like 25 days that I'm filming in the next quarter.
Wow.
So almost a whole month, like entire of the next quarter I'm filming. So we'll see. We'll see if it actually, translates into anything, but we're going to try.
Yeah. I've heard that you have to do it consistently for like 2 to 3 years before you build up enough of like a following for it to really make a difference. But some people do it a lot faster and some people take longer, but you're already like a year and a half into it or so?
The podcast, yes. And then, I have a YouTube channel, and I've actually had that channel for 10 years.
Oh, wow.
But for my residential real estate business, I started a YouTube channel for that in 2018. And you're right, about 2 years later, two and a half years later, I started seeing the results kind of come in from that. But for capital raising, for for all the investment stuff that I've got going on right now, it's really only been about 6 to 12 months that I've been, consistently making content. So we'll see, we'll see.
It's a grind. I think I was talking about this on the last episode, but, I primarily, actually exclusively used LinkedIn for raising capital and meeting people. And I'm kind of burned out. A lot of times now, people that are leaving comments are not actually people. They're AI robots, or they're just leaving a comment so that they can get engagement on their own content. So it's kind of just like a closed loop bubble, within our space. And it's frustrating. I still do get plenty of leads and business off of LinkedIn. But I don't feel as passionate about posting. Maybe that's because I've posted too much in the last few years and I'm just like tired of it. I don't know. It's tough to stay with. I really admire the people who have been able to stick with it after years and years, like with your YouTube channel. Like, oh my goodness, 10 years. That's a long time of making content. So that's awesome you were able to stick with it.
Yeah. Well, there's been so many, iterations and versions and everything, but it's interesting. Now, question on the LinkedIn thing, because we've talked about this before on previous episodes, but did you also find that it took a few years to kind of ramp up and start getting traction there? Like, when did you first start making content on LinkedIn for the purposes of lead generation for your investment business? And then How long after that did it really take to see like substantial results?
I really started in the beginning of 2023. Took about a year to start seeing results. It was probably 6 months until I started having posts that were getting, 100,000 views, really solid individual posts. But then about a year before I was really bringing in leads consistently. And that's not normal. Usually it takes people a lot longer. And the reason why, I think we discussed this in the last one, was just doing it consistently and then iterating, doing more of what works and less of what doesn't work, and just focusing on the stuff that's actually converting into leads. There's one guy that, if your viewers want to check him out, absolutely incredible. His name's Cole Baker. He lives in Denver.
Yeah.
But it's not like he has a large real estate portfolio or anything like that. But he got on LinkedIn and started posting every single day at specific times and engaging with all the comments and engineering his posts day after day to make them like what everybody wanted to see, and totally like relatable and interesting. And he really just engineered the crap out of it. Within like a year, I think he already surpassed 20,000 followers. So it's like one of the most insane growth stories I've seen. And he actually like left his corporate job and started his own business completely organically from LinkedIn and just posting every day and talking about what he's doing. It's really an incredible story. I would encourage people to check out his content for inspiration. Yeah,
actually, it's funny that you mentioned Cole. He had reached out to me less than a year ago. I think it was like 6 months ago, and he was offering up. I think he's doing that for other content creators right on LinkedIn. He's now helping them write posts and all that stuff. And I'm like, so I thought it was interesting.
It's a cool business. I have mixed feelings about utilizing that strategy. I wouldn't do it within my own business, but he's offering a great service and he knows what he's doing. But I do really think that people need to be writing their own content. If you're doing thought leadership, the thoughts need to come from your own brain. I really believe that. I don't want to be interacting with a bunch of AI. I don't want to be interacting with 20 people who are really just Cole, that I think are 20 people. And, I want to be talking to people like for real. So not something I think I would use in my business, but he's really, really good at what he does. And if you're looking for, lead generation, that's someone you should talk to.
Yeah. I definitely think, I've studied his stuff, and he's for sure like a great example for someone that's looking to just kind of get started. Also, you're a great example too. Like, just FYI, I totally rip off and duplicate, some of Elijah's stuff. No shame, I'm like, hey, it works for him. It should work. It should work for me. Let's go.
Feel free. I actually stopped scheduling stuff. I stopped scheduling stuff, and I stopped spending a ton of time babysitting my posts because I was getting burned out from it. But like, I was seeing the most progress with my lead generation when I scheduled posts and babysat and actually spent a lot of time engaging on LinkedIn. And I'm just burned out and lazy. I have a backlog of like 2,000 leads in my system that I never spoke to on the phone, that I don't know. I don't know who they are. I can't pitch them deals because I don't have a substantive relationship with them. So I'm really switching my focus this year to trying to establish relationships with my existing leads. So I've actually brought in a VP of investor relations to help me do that. So that's where I'm at now.
Yeah, man. And I just want to touch on that because like since the last time we spoke, so the first time that you came on the show, it's crazy how much progress you've made in like the last like year and a half-ish or so. Yeah, almost 2 years now. The first time you were on the show, you came in and I think it was just you. You weren't even working with Dave yet, right?
No, I was working with Dave.
Oh, you were?
Just me and Dave, though.
Yeah. So it's you and Dave, and then, but now, I just checked out your website a few days ago, and you've got a handful of people now. It's like a crew. You've got like 5-6 people on the team, right?
Yeah, don't let that fool you. Just because there are more people on the team doesn't mean there's more money making it into my bank account. But eventually there will be.
Probably. Yeah, probably
means there's less money. In my
I know how that
account.
goes. Yeah. That's part of the growth, right? You take one step back, 3 steps forward, couple steps back, 10 steps forward, right? Like that's just how you have to grow, especially if you're bootstrapping it and you're growing organically without any sort of like backing or funding, right? Which is actually why it's so difficult. I realized, as an entrepreneur in the Bay Area, San Francisco Bay Area, is like why one of the reasons that's so difficult to build a business organically here, as opposed to other parts of the country, is because you're competing against employers who have no ceiling when it comes to their spending, right? Seemingly, right? They just can spend endlessly.
They can pay $200,000 salaries and bonuses. Meanwhile, we're over here, offering commission positions. And
exactly.
So you got to get creative. Like one thing we've done is we've hired talent out of the Philippines. So that's it's more affordable than hiring out of the U.S. I have brought on people and offered them, revenue sharing or equity in lieu of, fixed compensation. I brought people on as just, on contract. So, and they get paid for doing specific tasks and accomplishing certain goals. So there's a lot of ways you can do it. It doesn't have to be the traditional $100,000, $200,000 salaried employee. Honestly, those are the folks. I was one of them at one point. Those are the folks who aren't, as motivated to get things done and be successful in the organization. They're more motivated by getting their paycheck every week. Whereas the ones who have their compensation tied to performance, kind of like a realtor, they're the hungry ones who are going to spend, go the extra mile to get things done. Yeah,
no, that makes a lot of sense. And there has to be some sort of incentive tied, especially if you're doing like any type of sales job, right? Like, especially if you're doing a sales job, but even without the sales job, there can definitely be performance based incentives for sure.
Yeah.
That's awesome, man. Well, it's cool to have, to see this growth that you've gone through. And, it sounds like if you've got 2,000 leads that you haven't talked to yet, like the lead gen isn't really an issue anymore. It's the conversion process now that's really kind of like the bottleneck for you, right?
Definitely.
Yeah. We, in real estate, on the residential side of things, what they used to do, and not a lot of teams are doing this anymore because it's just it's like super expensive to do, is to hire like an inside sales agent, right? So they hire, and then, they hire 2, 3, 4, but like, that's how you solve the lead problem or the conversion problem is you basically hire someone who's just kind of manning the phones all day, and reaching out to leads that are coming in and whatnot. But the difference is, right, like now it's not just about qualifying the lead and you also have to create that substantive relationship, right? So walk me through that process, kind of explain that.
There's nothing that can replace like the head of the firm going and meeting someone for lunch or having an actual like Zoom call face to face. And those are exhausting. Once you do, 5 of them in a day, you never want to do them again. It's brutal, to make substantive relationships. It really like takes a lot of energy and effort and time. So to do that, there are like some questions and things you need to discuss and talk about with potential investors, to build that substantive relationship. There's an attorney who speaks about this all the time, Mauricio Rald. I'm sure most people here have heard of him at some point. I would say he's the most talented syndication attorney and also the most conservative in the business. So he'll tell you a million reasons why you're going to jail and then tell you what you need, what you're going to do to get around it. But he talks about this, this questionnaire of specific things you need to ask surrounding, risk and the investments and their investment history and, where they're at. For me, it's more of like, let's build a real relationship. Let's talk about you, where you come from, your goals, what you do in your career, what you're looking to do in real estate, if you have an experience with it, but more just the basics. I'm not going to go down like a laundry list of questions and, get specific answers. I'm going to have a normal conversation and build rapport. And it's almost never the first conversation that gets someone to invest. It's usually like 3 or more, and sometimes 5 or 10. Yeah. We did like a study to see like who invests with us the most. It's either they have a personal relationship with myself or someone on the team, or they've been in our system for over 2 years. So they've been getting our content and talking to me for years before they even make their first investment. And so that's like, it's not quick or easy to build substantive relationships. There's a minimum that you have to do just to be able to legally send people deals. And for us, that's like, have a phone conversation, that lasts longer than a few minutes, and have it documented by inviting one of our AI transcribers to the call, or just typing up a note and actually having it documented in our system so that if the SEC ever calls, we can say, yes, we had a conversation on this day with this person and we talked about this. We have a substantive relationship now. But there's a huge difference between having a legally substantive relationship and having a real relationship with someone.
Right. And there's a lot of gray area there, right? It seems like, and there's so many different opinions. And yeah, I've been on, Mauricio was actually on the podcast about a year ago, but yeah, I've been to a bunch of his stuff and a bunch of his trainings. Yeah, I would completely agree with super conservative. We'll tell you all the reasons why you're going to jail. And yeah, so, but that's like worst case scenario, right? Often reality rarely ever reflects either extreme, right? But definitely, it sounds like you guys are doing everything that you need to do to create that relationship up front.
Yeah.
And so you don't pitch deals then at all to people that you have not had, that you wouldn't like consider to have like a substantive relationship with them. You're just like, you're not.
We don't pitch passive investments to those people. We only pitch passive investments if we have a substantive relationship.
Yeah.
Now, obviously, like if you're doing like a 506C raise, which allows general solicitation to accredited investors, you can. We just choose not to. But it's something I wanted to discuss, which is kind of a tangent, but not really, but also really important. So in this syndication world, we kind of work in a gray area of the SEC laws. So, it's not always black and white and clear what's right and what's wrong and what's acceptable and not, and what will get you in trouble. And when you're operating on the forefront of, like a new, and it's just not necessarily new, but, an untested, unregulated gray area type of industry, as an entrepreneur, you have to be willing to take risks and understand the consequences. But once you understand the consequences, you have to be willing to take risks if you want to get somewhere. And so there comes a point where, Mauricio's advice and some other attorneys' advice, no matter how you skin the cat, the answer is no. You're going to jail. And at some point, you need to be willing to take some type of calculated risk, understanding what the consequence is, so that you can accomplish your business plan and get to the other side, make a deal happen. And so for all of us in this industry, we're always asking ourselves, like, where is that line? What line are we willing to cross? One example of a line that we cross that some people don't cross, and this isn't going to get me sued because it's a gray area. So, sometimes bringing in contractors or co-GPs on a capital raise, some people would say, like, don't do it. You don't want to have more than a few co-GPs on a capital raise because it could look like someone's not materially participating and they're just broker dealering without a license. We go the step further to include in our consulting agreements with our co-GPs and our capital raisers and stuff. We put in specific things that they must do to qualify as, material participants so that they can participate in the issuer's exemption with us and not have to register as broker dealers. So we allow a limited number of people to essentially join Goldhawk as an affiliate through a consulting agreement and raise capital for deals with us as long as they're playing a material role. That's just one example. Another thing that we do is we broker active investments. So we're not talking about a deal where you're just putting in $100,000 and letting it sit. That's a passive investment. Those are securities. We're not brokering those without a license. What we are doing is we're finding like a family office or an institution that wants to write a JV check and come in and be a partner in the operating agreement with the sponsor in the deal and play an active material role in that deal. And that's not a security. And some attorneys would say, oh, well, you got to be really, really careful about because it's a very fine line between what's a security and not. And we're willing to take more of the risk of saying, look, this is a joint venture partnership between 2 or 3 groups. They all have roles to play in the operating agreement. It's spelled out. We're willing to take the risk that this is not a security and that we can be compensated for brokering that equity. So that's another example of risk that we take.
Mm-hmm. I was actually going to ask you about that because I had seen recently on LinkedIn, like you were talking about JV opportunities. You had family offices that were looking to write checks. So walk me through that arm of the business, because it seems like that's a new thing that you've been doing that you weren't doing before. So I'm really curious, what you kind of gave me the bird's eye view, but let's maybe get into the weeds of that a little bit. We'd love to kind of understand what that looks like. I think
the last time I was on this podcast, we were just doing fund of funds type of deals. These are when we raise capital in a separate LLC vehicle, and then we use that pooled capital to write a check for someone else's deal. It's like a feeder fund, but we're staying involved that whole time. We're raising money for LP investors. We are providing a lot of value to those investors. We're materially participating in the deal, yada, yada, yada. We still do that. And we're reviewing about 100 deals a month and investing in less than 0.5%. So it's 3 to 4 deals a year. We'll actually go and we'll raise a separate LLC, fund of funds, feeder fund, whatever you want to call it, to invest in that deal. And that's our core business line. That's how, we make a lot of our money right now. The new business line that I introduced within the last year was trying to go after much larger check writers and pair them up with sponsors as JV partners or co-GP partners, or even a lender relationship in the case of pref equity, which is essentially just an unsecured loan on a deal. And so we will go and we'll try to source checks that are over $1 million. Most of these groups start at 5 million, and we will introduce those check writers to the sponsor and say, let's finish the capital raise right here and now with one check. And if we're successful, you pay us 3% of the amount that's invested. And that's the business model.
Gotcha. Okay, cool. Now, obviously the reason or the rationale behind that is there's probably, if someone's looking for that kind of check size, your fund of you wouldn't have the ability to raise all that capital yourself. So instead of doing it that way, and the family office doesn't necessarily want to take a LP position and invest alongside of you in your SPV, right, into the deal. So instead of that, they're we want a co-GP. We're more interested in a semi-active role. So if you find a good deal, let us know. And then you basically act as a quasi. Yeah. It's you're it's not really an equity broker. Well, it is.
That's exactly what it is. Yeah. It's equity brokerage. We don't have to skirt around the language. That's literally what it is. And the way we do it is legal.
Right.
It's, anyone who's writing a larger check, anyone who's writing a check over $1 million, there's going to be strings attached to that money. It's not just I'm going to write you $1 million check and be a passive investor and just wait for your quarterly report. It's well, if you guys decide to make any big decisions like selling the property or encumbering it with other debt or doing literally anything that's a huge impact, we want a say in it. We want the power to override that decision. If you guys default on the senior loan or screw up or do some bad boy act, we want the ability to come in and take over management to seal up the deal. So and by nature, those carve outs and those clauses make it an active investment. You are playing a material role because you have decision making power in the deal. You're sitting on a board and voting on stuff. And so, by its nature, people who are writing large checks are active participants almost all the time. And that comes in the form of being, a JV partner where you're listed as a member or a manager on the operating agreement. And that's just how it works.
Now, couple questions about that. The first one is, from like a debt perspective, right? In that JV co-GP situation, are these larger check writers also signing for debt in some cases, or are they usually just kind of like staying out of that?
Yeah, it depends on the check writer. A lot of the lenders will require that anyone who's providing more than 20% of the capital signs on the loan. However, there are like any business transaction, there are always ways around every rule. And so you have a lot of investors who really don't want to be involved. And so they'll hide behind something, or they'll get something approved, an exemption, or the lender will just allow it, or some other reason. But there are definitely situations where they don't sign a loan. No investor wants to sign on a loan. And so their default is usually like, we're not signing.
Yeah.
And then they get down to a week before closing, and the lender's like, all right, here's the documents. You gonna sign it?
Yeah.
Yeah.
Well, yeah, I know how that goes. Well, so now coming back to your core business, right? Like the fund to funds model. Let's say that you're cutting a check for $2 million. Total equity raise is $5 million, right? Okay. So you're coming in with about 40%.
Yeah.
Have you ever tried to negotiate as opposed to an LP position, a co-GP position for the SPV?
Yeah. I've done that before. It's something that I look to do more of. The reality is that most of the solid deals that we see have capitalizations that are high enough that our contribution to the deal is not a meaningful percentage. By meaningful, I mean 40% or 50% or more.
Sure.
And so we're coming into the deal with 1 to 10% of the equity usually, and that usually doesn't buy us enough power to come into the GP, share in the fees and the decision making rights. That's the goal, though. So for anyone listening, I'm looking for someone who's gonna essentially provide, an anchor for my feeder fund direct investments so that I can write $5 and $10 million checks for these deals through the direct investment vehicle, and not just our $1 to $2 million checks. Because then it's an actual meaningful amount of capital, buys us a ton of leverage, and allows us to come in and essentially take control of the deal if we want to. So that's something that's definitely on our radar, what we want to do.
So coming back to how this all ties together full circle, right? And I'm sure that you've thought of this, but let's say that you find a family office that wants to cut, say, they want to come in, they want to co-GP it. Mm-hmm. Could you not also say, okay, investors, let's put $1 million of our own into this. And since I'm putting this all together, then I can also negotiate this fund that I'm putting together a co-GP position in the deal.
Yes. We are doing that right now on a deal in Texas, in Houston. Now, the way that this is working is Goldhawk sourced a family office to anchor the deal with $3 million. We liked the deal so much that we decided we also wanted to make an investment of $1 million. Actually, we asked if we could do 1.5. We got cut off. And then, but the way that works for us is we already have a proxy vote in the deal by way of that family office. And that family office relies on us heavily for advice. And so, we are essentially have the leverage of a GP through that family office. But we're also making our investment separately as a limited partner in the deal and getting special terms in it. There's already 3 managers on that deal. There's no need for me to also jump into the mix when my client is already on the board.
Gotcha. Okay. That makes sense. Yeah. And I mean, co-GP, there's certain things, right? Like, first of all, you'd have voting rights, right? But I think another big, and obviously like more say over like the overall like operations of the deal. But, just from a returns perspective, I mean, if the deal performs, right? It's a big if, but if the deal performs, then the GP is always going to take a bigger slice of the pie, right? So I'm assuming the investors that would be attracted to that model would be a little bit more risk tolerant, right? Because there's going to be a higher degree of risk, with that kind of investment structure.
Oh, I get it. So you're saying like have the feeder fund LLC have GP ownership, have like a GP position.
Correct.
No, I wouldn't do that. I would essentially, if I'm going to do that, essentially like Goldhawk Capital as the manager would be in the GP position, and then the feeder fund LLC would be an LP investor
position
in the deal.
I see.
Like you only join the co-GP if you're adding value and managing, playing a role. The limited partners are not doing that. The LLC as a whole is not doing that. Just the manager.
There was a fund manager I had on the show a while back, Julian. Have you heard of Colony Hills before? Colony Hills Capital?
Yeah, he sends us deals all the time.
Yeah. Julian Bogle. Yeah. So, Julian, they have a really interesting structure. He has, he runs his own, like they have their own family office, like internally, right? But the way that they've kind of positioned it is there's 3 main contributors to the equity, to the cap stack, aside from the debt. There's Colony Hills itself, right, which contributes to the cap stack. Then they usually bring in an anchor investor, right? Okay. That's bringing it like a JV partner, right? Typically. So they have a ton of family office relationships, whatever. And then the rest of the equity is brought in by what they call their co-GP fund. So they have a fund that effectively participates in the GP, in the GP as opposed to an LP position, right?
Okay.
And so that's how...
That's weird. Like, why wouldn't that fund just be like an LP fund?
Because they contribute to the G. So, for example, right?
They're doing the GP co-investment portion of it.
The GP co-investment comes from risk capital.
That's cool.
They're doing,
yeah. And they get there's more risk and there's more reward. Yeah.
Way more reward.
Cool.
And also more risk. Yeah. Yeah. So it's a very interesting structure. And when he said it to me the first time on that, I was like, hold on, can I rewind real quick? So we did I was like, I need to hear that one again.
See, I'm a little selfish. Like I'll go join as the co-GP and have the investors be LPs. Like I'll take the extra risk and the extra reward. I don't necessarily want to give that to the investors.
Yeah, it makes sense. And I think the reason it makes sense for them is because they're the operator, right? Yeah. They're the ones kind of running the show. But for what you're doing, it makes less sense to kind of like do it the way that I just described, because it's a different business model, but it's an interesting one.
It's funny. So we did that once with a deal in 2019. And anytime the asset management fee gets paid, and I have to divvy it up amongst all the members who didn't do any asset management services, doesn't make sense.
Yeah, no, I totally get that, man. I totally get that. So, fund of funds, it's a model that gets criticized sometimes for various reasons, right? For some of the reasons we've already discussed, but it also gets criticized for double promotes sometimes. There's obviously the legalities of it. Sometimes there's less control. So what's the response? Like, what would your response be to those criticisms?
Yeah, they're totally accurate. 95% of fund of funds are not great. I mean, have you met a fund of funds manager who consistently raises like over $2 million for a deal? Like, I don't think it exists. There may be one who can do it like, a few times a year, right? It's most of these fund of funds groups, the managers are not as sophisticated as they should be. I'm not saying they're dumb. They're smart people. Yeah. But I don't think they're studying the market. They're not seeing as much deal flow, as we are. And they take whatever deals come to them. There's a few really well-known operators who advertise a lot that have not so great deals. And, the fund of funds guys will flock to them because they make it easy for them and they're advertised and they don't have to go out and find more deal flow. We took the hard approach of saying, we're not just going to take any deal that comes to us. We're going to go establish deal flow. So I spent 6 months not advertising to investors and just trying to build relationships with operators. So now we have a list of 500 operators that send us deals every month, and we go through 100 deals a month, which allows us to only invest and select the best of the best in America for middle market multifamily. It's less than 0.5% of the deals that we look at. Your comment about the double promote and the fees, we got so good at negotiating our position with our large check that the economics for our feeder fund got so good that it built in enough room for us to take our fees and get our investors the same, if not better, returns than anyone else who's going in a deal. Yeah, we also are probably the only feeder fund that cut out the double waterfall. So you get an 80-20 split from the sponsor down to the fund. And then a lot of these fund managers will do another 80-20 split so that they can get paid. We don't do it that way because why should we be compensated based on the performance when we had nothing to do with the performance? The way we look at it is this is a transaction. We did due diligence. So up front, we get a due diligence fee. We have some basic administrative expenses to man the portal, hire the virtual assistant, and to do the distributions and the tax planning and everything like that. So we have a fund admin expense every year, and it's smaller. It's a lot smaller than a traditional asset management fee. We're not managing the asset. We're not doing any of that. We're managing the investors. At the end of the deal, we don't take a promote based on performance. We have an exit fee, a transactional exit fee saying, thank you. We did the work. We orchestrated the deal. We transacted it for you. We're not going to take, a percentage of the profits. We're just going to charge you a transaction fee like a real estate agent would charge to sell a house. And so that's our model. That's what we do. And that's much more aligned with what our business is.
Yeah, that makes a lot of sense. And you're right. It's like, why are we getting a performance carry when we had nothing to do with the actual performance of the investment? Now, on the flip side, you were prudent enough to identify a high performing investment. There should be some compensation for that, right?
And there is, because that exit fee is on a sliding scale based on the sale price of the property.
Makes sense.
So if the deal does really well, we get paid. We won't get paid as much as if we were getting paid promote on profits. But also consider the other side. Our downside is limited too. If our compensation is tied to a percentage of sale price instead of profits, we will get our percentage unless we decide that we want to lower it in the benefit of the investors. So there's less upside, less downside for that strategy.
So, I'm sure that there's investors who are listening right now that are probably curious about how you've gone about building that operators list, right? So you talk about, hey, I spent the first 6 months, vetting operators. And I believe that probably one of the greatest barriers to entry, I know that one of the greatest barriers to entry is access, right? So it's like, hey, how do I even access these kinds of opportunities? So how did you build that list, and how do you continue to refine it, add to it? And is it just like they're all coming into you now? Are you still doing consistent outreach? Kind of walk me through the then and now.
Well, we've been owner operators ourselves for like 10 years. So we had some relationships in the industry, not many. And then when we started doing feeder funds, we got on LinkedIn And we met a lot of operators that way. You'd be surprised. You go on LinkedIn, like maybe it's not a surprise, and you just post, I need to invest $1 million within the next 2 months. Send me your deals. That's it. And you put an email address or whatever, and you'd be shocked at how many people send the deals. So anytime anyone sent us a deal, we would input their contact info into our CRM and start building our list that way. Enough of these LinkedIn posts and your list becomes a couple hundred. And then every month or every other month, I'll send the same exact email blast to that list saying, we're looking for deals. Send me your deals. Like, that's simple. It's like literally it. And I sent it out yesterday to like 400 of them and probably got back like 40 or 50 emails. I can't even get through them. So it's a lot of like just posting like on LinkedIn, talking about needing to deploy capital. If you have a particular investor, let's say this guy's got $1 million he needs to place, you say, make the post, I'm working with this investor who needs to allocate $1 million soon. He's looking for multifamily in the Sun Belt with an 8% cash flow, whatever. You just put that on LinkedIn, and then everybody will start, reaching out because they're desperate for that $1 million.
Yeah, that's there's no shortage, and that's really why a lot. So you inspired me, brother, because like when you and I first met, I was really trying to break into the operations side of the hotel business, right? That's where I was like, hey, I want to be a hotel owner, right? Which I still do, but I spent like a year, worked with guys that had 20 hotels, and we had deals that we were doing, and they were like falling through and all these things. But in the trial and error of all of that, the thing that stuck out to me the most is that the asset managers come and go. The money guys always have a seat at the table, because everyone wants the money. Everyone needs the money.
The biggest
and even
problem.
Even if they have the money, they want more money to do more deals. And so I was like, hold on a second, and by the way, I think one of the smartest things about this fund to fund structure that you do is that there's a wide variety of investors that you get access to, that you meet, right? And every investor has different profiles. They have different wants and needs. And if you're an operator, you've got to have an investment thesis, and you're like a one-trick pony, right?
Yeah.
And then like if you're a guy that's doing a value add, high risk, high reward, well, the guy that's just like comfortable with like, low to mid-teen IRR, but like super safe investment, they're never going to invest with you, right? And so the ability to pair investor, subsets of investor profiles with deals makes a lot of sense. And on the other side, and the part that I think is really cool, is that you now get to see behind, under the kimono, so to speak, right? You get to open up all these operators' kimonos and see inside and figure out, hey, what are these guys doing that's so great? And then in 5 to 10 years, if you did want to do, your own fund and be the operator and everything, like you now have the world's greatest playbook, right? Yeah. on how to operate those assets.
Resources, just pick up the phone and call any of them, right? So
exactly.
So people will send me a deal, like for example, in like Dallas, and they don't have enough experience, and they need like a partner, a co-GP on that deal. I'll go sort through all the list of all the deals that have come into us in Dallas, and I'll have a list of 30 operators, and I can now call up any of those operators and be like, hey, do you want to partner with this guy on this deal? And that's in value. Like, I wanted to become an operator myself, I would just, I could find a co-GP, I could find a family office to fund that deal. I know what they're all looking for. I can underwrite it, underwrite it well. I know what I'm bad at, but I also know who to find that can do the job better.
Right. So that's why I'm just like, dude, this business model that you run makes a lot of sense. And you're also providing, like, forget the people that forget the naysayers, the people that criticize, they just don't understand, right? The average investor doesn't have the knowledge, the time, or the access to go out there and consistently source great opportunities. They're going to get, you know what's going to happen? They're going to get sold snake oil.
Yeah. It's a full-time job to, I mean, we have a team, like it's full-time work for multiple people to like get the deals to come in the door and then conduct due diligence on all those deals and then package them up in a way that's palatable for an investor. It's a lot of work. And, you know, as just like an LP investor, you know, most people are just investing in whatever gets sent to them, you know?
Yep.
They don't really know what other options are out there or what to look for. It's scary. That's why, like, I think it's better for limited partners to engage in deals through people like us because we're spending our whole day analyzing the deals.
Yeah. Right. Yeah. And if you're sifting, you said like over 100 a month. Is that what you're doing right now?
100 a month. Yeah. Between 50 and 100. But yeah.
I mean, that's insane velocity, man. So like, how many people do you have on the underwriting team?
So there's really 3 of us. Let me walk you through the process. So operator sends us an email saying, we'd like to show you this deal, and maybe we'll have a pitch deck attached. Chelsea, our manager of investments, will then send them a list of documents that they need to send us. These include the Excel underwriting model, the broker's OM, maybe a rent roll and a T12, an appraisal, CoStar report, the loan term sheet, you know, all the different documents you'd possibly want or ask for. The operator's track record, their personal financial statements, like whatever is needed. Once she gets those documents, she inputs like 100 data points into our Airtable and in like a new row. We keep every single deals. We keep a lot of data. And so we can like produce these reports to show where the market's moving, which is really cool. But she'll go and she'll input all that data in, and that Airtable will automatically calculate metrics and either accept or reject the deal based on no-go criteria. And these are like the crazy no-go criteria, like operator has no experience, or like the loan term is like 12 months long, where there's things that it's like we're just not going to pursue no matter what. Ground up construction deals, stuff like that. And so once it passes that stage, it goes to me for like a quick review, just to like put my eyes on it before it goes to an analyst. So I'll do a quick pass, and if I think it's worth doing due diligence on, I send it over to our analyst, Jaden, and Jaden will essentially go through all the documents and the metrics, the rent assumptions, like everything like that, and produce a few paragraphs of opinion on the deal. And if he needs something else to clarify questions or red flags, he'll reach out to the operators and get that information. Once it passes that stage, it comes back to me. I'll either say yes or no. If I say yes, then we attempt to get an engagement letter in place with that operator so that we can be paid if we successfully source capital. And if they agree to that, at that point, we then start sending to the investors. So it's kind of a long process. It could take a day. It could take 2 months. Depends on how fast the operators respond.
Yeah. So you're sending an engagement letter to the operators to agree to paying you if you source. Is this for the family office scenario? Right. Okay. So, but I'm assuming that in the case, or you're just doing that to cover your bases then?
No.
Like so you're doing that for every deal, or just
every
the ones
single
that
deal we do that process. Once we get down to the end of the process, I will say if it looks like something that would meet our personal buy box, we will make a direct investment for it. But at the same time, we're going to the family offices.
Gotcha. Okay. Man, that's really smart, man. I mean, that because of all the deals that you're looking at, I mean, your direct investments are going to be a fraction of what you could theoretically shop to the greater market, right? So yeah, it's just a great way to continue. Like, you're already doing the work.
Yes.
You're just finding another way to monetize that same work.
Yeah. And I think like what really sets us apart is that we also invest. 99% of equity brokers, they don't invest in the deals.
Right.
We are actually investing in deals. We have run deals in the past. We were operators. So we kind of know. The goal, I think, for me at this point is to have this business turn into more of a real estate investment bank. By that, I mean, we are kind of preparing and orchestrating the whole transaction, as in, the deal comes in, we're, conducting due diligence, preparing the marketing materials and sourcing the capital for the deal, doing everything up until the point of closing. And then we take our fee and run, but not just that. I also want to have a co-investment fund, which is right now it's our feeder fund, but eventually it'll be like a real fund of funds that invests in multiple stuff, not just individual deals. But I would like to have a co-investment fund that comes in alongside our clients in the deals. That's kind of the goal. I'd like to put $100 million in a bank account and be able to do that. Going to a family office and being like, hey, you guys put up 10 million, we'll put up 5 million. Let's finish this capital stack together. That goes a long way with them to tell them that you're putting.
Yeah, that makes a lot of sense. And that's pretty unique. I mean, I don't know. Are there people that are doing that right now?
I'm sure there is. This is not new. In the institutional world, there's all kinds of things like that happen all the time. Yeah, it's just all, you don't care about it.
Definitely not. Last thing, right? But it's super interesting, man. I mean, it's crazy how in our world, these are all things that make a lot of sense, whatever. But you go out to the general public, the stuff that we're talking about, 95% of them, more than that, probably like zero idea. They have zero idea. And so I think education is a big part of it.
The jargon of it and like the structures of it can be complicated and confusing to someone who's not heard of it. But there's always a way to, I guess, dumb it down or simplify it in a way that anyone can understand. So when I'm like at a bar and I'm trying to explain what I do, the way I explain it, the way that I do this is I pretty much tell people that there are companies that are going and buying apartment buildings and they need large investors to provide the money that's needed to buy those buildings. And I find them that investor and I take a fee for it. It's that simple. Anyone can understand that. That's really easy. And then the second part is sometimes I'm also putting money into the deals and I get that money from my friends and family and my own bank account, So it's pretty simple what we do. It's just the way you explain it, is different.
Yeah, 100%. And coming back to what we were originally talking about here and we're already at an hour, man. This is crazy. Time flies when we're chatting.
Some podcasts go 2.5 hours long.
They do, honestly, man. I know, and like those are marathons, and I really want to, like, I'm thinking about moving out of the area at some point and setting up shop in Vegas or whatever. I want to start doing live podcasts weekly.
Yeah,
and like flying people in and I think a live podcast 2 hours is like a good, like hour and a half, 2 hours. Yeah. It's like a good time. It's like, you got to make it worth it at that point. You're taking the time out to get face to face. You might as well make it count. So LinkedIn has been your primary way of sourcing investors. Yes. Have you found any other, aside from like networking and family and friends and stuff like that, have you found anything else to be, particularly, has any other lead source kind of like helped you grow that investor list? Or are you primarily still getting like majority of your leads from LinkedIn?
No, like I said, I'm lazy. Like I haven't tried. Most of my leads come from LinkedIn or word of mouth and friends and family. That's like, and that's really it. Like I have not tried TikTok thing really. I've not tried the Instagram thing. I just don't. I just don't have time in the day yet. To do that stuff. Grinding.
Yeah. Well, honestly, I don't think you're going to find a lot of quality stuff on Instagram and TikTok. Anyways, I don't know if you've seen Hermosi's. I mean, I know that you're also a big Hermosi follower.
Yeah, I watch his stuff.
Consumer of content, but he had a great video up about like kind of like the tiers of like lead generators for his business, and he kind of like broke down all the different social media sites. Have you seen that one?
No, I haven't.
I'm going to send it to you after.
Okay.
It's somewhere, but he broke it down really well. And that's actually what like reinvigorated me with YouTube. Cause like he had it up in the S gear category. It was like YouTube and LinkedIn was also super high up there too. So, but TikTok was like down at the bottom. He's like,
really?
Yeah, dude, lots of views. Like, yeah, because you get lots of views, but like, what is it actually?
No action.
I mean, like, why are the dancy girls on TikTok with millions of views still living in like a crappy apartment? You can see it. They're dancing and it's a crappy apartment. It's like, what do you, it's not actually making the money. You know what I'm saying? Yeah. Like it's just getting him a lot of attention.
What did he say about OnlyFans?
He didn't rate that one. But yeah, I guess you could use it to drive to OnlyFans. That's funny. Yeah, man. I mean, look, we've covered a lot of ground today. You know what I'm going to ask you though, is to leave the audience with one final gold nugget. So I'm going to let you take it from here.
Okay. All right. So we see a ton of data, obviously. We're tracking the movement of the multifamily middle market in the United States. And what's happening right now, you've got interest rates that are relatively high. They have not really come down much. They bounce up and down, but they're still pretty high, which sucks because that's a lot of money going out the door to the bank. So cash flow is low. Meanwhile, at the same time, what we're seeing is that the cap rates on properties are actually going down, which means properties are getting more expensive. At least in the last this past quarter, Q1 of 2025. And so what that creates is a situation where very few deals pencil. The spread between your cap rate, which is like your going in yield, and how much is leaving to go to the bank in the form of interest rate is very small, and most of the time it's negative, which means more money is going to the bank than is coming in the door. Which is not a good situation. Investors don't like that. That's risky. And so very few deals are penciling. What we're seeing as competitive is if you can acquire your deal at a cap rate that is at least 1% higher than the interest rate you're getting on your senior loan, you can accomplish that with, an assumable loan or just by getting a higher cap rate on the deal by negotiating well. Those deals are going to be more competitive because you're going into a lot more cash flow. It's a lot more stable. And then once you've accomplished your business plan, your stabilized yield, so your net operating income divided by the total cost or how much money you spent on the deal should be at least 7% by year 3. And that would make you competitive. If it's a value add deal where you're putting in a lot of work and you're taking risk by spending a bunch of money to try to accomplish a business plan, that stabilized yield on your total cost should be at least 8%. And that will put you in the competitive tier. Beyond those metrics, having newer properties, having at least 5 full cycle exits or partnering with someone who's got 5 full cycle exits will put you in the top 1% of the deals. Once you get there, it's just a matter of buy box preference for the investors. Like for us, out of that top 1%, less than half of those will meet our personal buy box. And so, yeah, if you're putting deals together, you want to be competitive, make sure you're going into it solid basis with, great cash flow going in, a high stabilized yield so that it's actually worth it to invest. The business plan was worth spending the money, and then make sure you have experience. And that's really it. It's pretty simple when you break it down.
Yeah, I think that's great information because obviously, like, guys, Elijah's looking at thousands of deals a year, like over 1,000 deals sounds like a year, right? So
yeah,
you have insights into the multifamily sector that most people simply do not have. Because I would argue that probably even a lot of multifamily operators aren't underwriting and aren't looking at as many deals as you guys are. So it's very interesting. I think like the what you just shared, especially with cap rates going down. I'm shocked to hear that that's happening in multifamily, not happening in the hotel sector right now. That's for sure. So why do you think that is, bro?
More people came off the sidelines when Trump got elected. And so there's more capital being deployed.
Yeah. Well, so much for the blood in the streets and all that. When is that going to happen? Are we ever going to see that?
It's funny. It depends on. So when you ask someone, it depends on their political affiliation, what their response is. Because if they're on the left side, it's happening any day now, where we'll be in a big recession and the whole world's going to collapse. You ask someone who's more on the right side, it's like we've just entered the golden age of America. It might hurt for, a few months or a year, but after that, we're going to have the best period of prosperity anybody's ever seen. So it's really a mixed bag. Nobody actually knows what's going on. I'm hopeful that the supply issues will be mostly resolved by either the end of this year or mid next year. That's just because the cost of construction got so high with interest rates and materials that people stopped building the last couple of years. And so you're not going to see as many deliveries, but the populations in these areas will continue to increase. And so, all the available supply is getting absorbed, and that will really help with at least the real estate market in multifamily. It'll allow occupancies to increase, rents to be pushed up, property values to increase. I think the interest rates will come down at some point this year. They have to if the federal government wants to refinance its debt. I just think that's positive as well for real estate. So I'm optimistic about what's going to happen.
Yeah, me too. It's just specifically in the commercial sector, real estate sector, with all of the loans. Now, if rates do come down, then suddenly a lot of those people might be able to absolve themselves of their miscalculations.
Yes.
Yeah. So I guess that would also solve that problem. So I guess we'll see.
But I guess I'm really thankful for the spot we're in right now, because with dislocation and illiquidity, it creates tremendous opportunity. Once rates come down, property values are going to go up even more because everybody's going to be buying. And so all these sweet deals we're seeing right now are going to disappear. So right now is like the buying chance. Do it before rates come down. Because once rates come down, prices go up.
Bingo.
And you missed out. Yeah.
Bingo. Yeah, man. Tons of opportunity right now. Tons of opportunity. Go get yours.
Love it.
Love it, man. Elijah, thanks for stopping by, bro. We'll see you again soon, I'm sure.
Appreciate it. Thanks so much, Tim.
All right.